Good afternoon, everyone. And now, as the minute has passed, just to be precise there, my name is Christian, part of the Essex Startups team. Welcome back to the fifth and final day of AI Week. Throughout, as you may already know, if you attended all the other sessions, please do participate in the session. If you have any questions, if you would like to comment on anything, just pop it either in the chat or the Q&A function that you have on the bottom there. Today, I'm joined by Carmine, who will provide more of a research perspective onto the financial industry. So we've got an interesting talk ahead of us. Carmine, would you like to take it away?
Yeah, thanks a lot for the introduction and the invitation. It's always nice to be back at Essex. I mean, I live here, but the university would have been very nice to be there. Yeah, so now I work at King's College London, but I maintain a visiting position at Essex. And yes, I wanted to talk to you about AI in finance, but in particular, I wanted to stress what's unknown and what a computer science researcher could contribute to the area. So, and I want to start from what is known and done in practice. So I'm quoting from a survey of the Bank of England in October 2019. And yeah, I've highlighted the key findings of the survey amongst others. So the first one is that 2/3 of the respondents of the financial companies in the city already use machine learning in some form. 1/3 of the applications are used in specific business areas, in particular banking and insurance. And there are some applications like fraud detection and anti-money laundering that have the majority of the applications and where AI is more mature. And also a bit of customer service and marketing. Now, against this backdrop, what could a computer scientist do, and why should we care about the financial industry? Are you actually, should I move this as well? Yeah. So, and why is it actually the case that computer science can contribute to the area? And I want to ask three main questions in this presentation and discuss three main questions. So the first one is, can we as computer scientists design new machine learning models to either understand the way asset prices evolve in financial markets, or manage risks better? Okay, so these are the two technical machine learning questions. And the third question I'll be talking about, it's about designing better financial markets. Now you can see that the keywords I've used here in my questions is designing, because I think it's one of the things that as computer scientists are pretty much good at doing. So let me start with the first question. Okay, now what's, yeah, okay. Yeah, so I want to start by discussing machine learning models to predict price movements. And I'll be discussing two different applications, one on cryptocurrencies and the second one on foreign exchange. So these are, of course, two different, they have different properties. So cryptocurrencies are more modern and more harder, and they are harder to predict, and forex is more established, and it's got big volumes. And these two different asset classes that we're going to talk about are based on joint work with my PhD student Fan and a master student at Essex, a master in computational finance, Wai-Chung Chun, of some years back, plus some people in the city. And this has been just accepted at the European Journal of Finance. And the second is with two people from Essex, John O'Hara, who's an academic, and Shen, who's a PhD student at Essex, that I supervised together with John. This has been, this has appeared in a conference, a new conference called International Conference on AI in Finance. This is just been, the 2020 was the first edition. And this conference also builds on some specialized workshops that have been run in the major AI conferences. And the reason for which I'm discussing that is just to show that the community of AI and computer science is recognizing that finance as an application area is interesting and deserve to be studied, because this can give more, let's say, more applications and more questions to be analyzed as computer scientists. Okay, let me start with the first one, in which, as I said, we're going to talk about cryptocurrencies. And yeah, so this is always in the news. So I think I don't need to discuss what Bitcoin is and how is attracting more and more volume. This is a picture I took in 2019, so up to 2019, and you can see how prices evolve. And now it's much higher than that. It's around 60K, I think. But in any case, what's interesting about cryptocurrencies is that there is a lot of volatility, which means that it's much harder as an object to predict, right? So it's going to be very hard to tell you what the value of Bitcoin is going to be in a month, okay? So again, if you look at the numbers of May 2019, now it's May 2021, and the price is 6 times as much. So this is, it's pretty wild. And then the question will be, can I use machine learning to predict Bitcoin, and exactly what the next tick, and this is a financial terminology, so what's the next movement in the price of Bitcoin, and despite this large volatility of this asset. And the first answer we get is, for example, by designing a particular AI model, which machine learning model that's a deep, an evolution of deep nets, we can get some decent results. So for example, if I focus here on Bitcoin versus USD exchange rate, so we can get a 70% accuracy if I use 10% of the data to train, a bit more if I get 20% of the data, and so on and so forth, up to around 83% for 70% of the data. Now the data I'm using, it's offline data. What this means is that we downloaded a bunch of data points, let's say 1 day of tick data, high frequency finance data, and then we run offline on our machines. We split the data, we pre-process the data, and we design this model that allows us to get 83%. Okay, now it's great because 83% is much better than chance. And by the way, the task I should have defined is, I would just want for now to understand whether Bitcoin is going to go up or down. Okay, so always start from the simplest possible task. So a random choice would be 50% accurate. We're getting 83%, which means it's much better than chance. Now, the question is, again, as I was hinting at before, what we are doing, it's very much offline, and it's not very applicable in real life, right? It's always easy if I can download any data set, I can get always 100% accuracy because the data is there. I know how the data is. I know that this is cheating. I always have to split the data set into training and test. It's all fine, but still the offline data, it's something that bothered me. So the next question was, how well do we do on live data? So one advantage of cryptocurrencies is that data is freely available. So if you look at cryptocurrency exchanges, you can subscribe for free, and you get an API, which is an application programming interface, a function with which you can download the data as things happen on the exchange. So we said, now we saw that this offline, we get 83%. Let's try it in real life. Let's try it on live data. And as you can see now, we have the 50% line, which is what I said, random guessing. At the beginning, for the first 1,000 number of iterations, we get something that's closer to the numbers we saw in that table before, so around 60, 70%. But then after the 1,000 mark, you can see that our results and the accuracy of our prediction really much degraded to random chance. And I think one lesson here is that a number of papers and a number of contributions, they claim some results, but they always only test these models on offline data. And it's also important to test these models on live data, because you can discover that effectively the model that we produced doesn't work. So to fix it, we changed the model. So technically speaking, we use a sort of encoder-decoder architecture. I'm going to discuss later what this means. And the other idea is also to retrain the model often. Now, the two things here to notice are the following. First, this change of model is also motivated by the fact that when you work on live data, you can't run your machine learning prediction algorithm for 10 minutes, okay? So you work on live data, you also need very fast execution. And by playing a bit with this kind of architecture, we managed to get a decent running time. And the second is that what happened really in the previous picture here, the reason for which after the 1,000 mark, the prediction very much became chance, it's because the condition of the market on which we trained the network had completely changed by the time we got to the 1,000 mark, okay? So what this means is that cryptocurrencies, as we said before, they're very volatile and they change very often, and price moves quite wildly. Whatever the network learned on our training data become obsolete by the time we got to this 1,000 mark.
Kamil, I've got a question actually. So for anyone watching this as well, I've only scratched to the surface of AI myself. I think I constructed like the simplest model in the world. I'm only like scratching the surface with it. So I only understand the basics, and probably not even that. But with that model, obviously the prediction value there falls quite sharply, and you train that on historical data that you've gathered.
Yep.
And so how does retraining the model, as it were, what I don't understand is that if you train it on the market, on all the historical data of the market, all the stuff that you have from the past, what retraining it, what does that do to it differently?
Yeah, basically, so, what happens is that assume, okay, so let me go back to, for example, assume you're training the network. Now I don't know why I can't get it. Do you see also your faces or not? It's just me. Do you see the slides? Okay, great. It's fine. You just see the slides. So assume you're training, we downloaded the data from 2017 up to this point. Okay. So what the network learned is very much an uptrend. Okay. Now, as soon as you move now to this downtrend here, which is a bit covered by the number, so the network is really in a completely different market conditions, right? So whatever learned in this part of the picture is irrelevant to predict what's happening here, okay? So retraining simply means that as you may think about the rolling window, for example, that's one of the approaches. So if I'm trying to predict what's gonna happen tomorrow, I'll train the network with all the data I get up to today and in the past month, for example. So if you do that regularly, like we've done in this case here, you see that we are able to maintain a stable, very good accuracy of 75% plus. Okay. So of course now, the next question that we also analyze in the paper, but I didn't include it in the slides, is retraining is an expensive step. Can we optimize it, and how often should we do it? And there is also all this sort of engineering questions that can be considered as a computer scientist, okay? And now the other thing I wanted to say, we stopped in this work, actually in the published work at the prediction, but now the next step would be how can I use this signal to make trading decisions? And this is a completely different research question that is valid and very interesting. Because, for example, here, what I can tell you is that when we tried to use the prediction that our model gives, which again, it's on live data above 75%, it's much better than chance. We couldn't make any profit because by the time our order got to the market conditions had changed. So you see how there is still more aspects to be considered in the pipeline of I have market data, I use AI to make prediction, and then I want to make money. There is a number of steps to be considered. And so this was the first example. The second example I wanted to discuss is Forex data. So here, as I said, we take a much more established market. It's also a kind of different market because it's not a so-called limit order book, which contains all the orders that people submit to buy or sell Bitcoins. High frequency finance, it's a so-called quote-driven market where at each time step or wherever you a quote is released, you get two prices, a bid and an ask. So a bid is how much the market maker, so the counterparty, is willing to pay to buy the currency, and the ask is how much they're willing to pay to sell the currency. Okay, so this is typically when you go to airports, you always see these booths where they do FX exchanges, and you can always see the two prices, and the spread is the difference is called the spread, and this is where they make money and why they do it. So in this case, then we took high frequency exchange rates. So you see that the difference here is slightly more than a second, for example. So for a month, this is a very big table with in excess of 1.5 million of rows. And the intervals are irregular because this is one characteristic of high frequency finance, that the data doesn't fit with our calendar clock, but it's got its own market clock. Now the output, and this is also part of the one important aspect to think about, is that in finance, labeling the data is very much something that we decide as designers, okay? Whereas in computer vision, for example, or in other uses of AI, labeling is a pretty uncontroversial step. Either the dog is in the picture or is not. In finance, saying that the market moves up or down might be dependent on risk attitude. So for example, if we look at the way we are labeling the data here in this study, which is motivated by a previous paper done by, I have issues with my controls, sorry. Yeah, now it should be fine. So that's this labeling is inspired by this paper by a group of scientists at Oxford. So what we do here, we take the average price in the past 5 minutes and in the next 5 minutes, and we calculate the change in the average price. And now you see that we say that the market has moved up if this difference is bigger than a certain alpha, has moved down if the difference is smaller than minus alpha, and it's stationary otherwise. Now, the extent to which, for example, alpha is 5% a good number, it depends on the risk appetite of the investor, for example, or what's special in the 5 minutes. This is all stuff that I can design in the context of finance. So what we do here, we use a very much advanced AI pipeline or model that's been used in computer vision to recognize pictures. And we use the financial data that we downloaded to create a sort of image. So the idea here is can we take a very well-established and powerful technique designed for other tasks and in other contexts, so in this case, computer vision and image recognition, and adapt it to the peculiarity of financial markets. And that's what we've done. So we've created an image with this, based on these numbers that are simply technical indicators on how well FX markets are doing, and feed these image into the network that works for computer vision and get our results of up, down, or stationary. And these are performances. So here it's a number of currency pairs that we analyzed in between July 2017 and July 2018. And you can see that things vary. The baseline here, 0%, it's a model that does not use AI, or it's a simple model. And you can see that in many cases we are better, and in other cases we are not as good. Okay, so part of the work we are doing now, it's also in understanding how to relate market conditions to the kind of performances we can get. We also tried to experiment whether there was some form of transfer learning. So if stuff that I learned on USD, Euro USD, for example, might be help me to predict what GBP versus Canadian dollar will do. Okay, it's a what Cirignano and Comte, two scientists at Oxford, call universal features. So they were able to prove universal features in stock markets, and we tried to see whether universal features existed in FX markets as well. And what we can see is that in a majority of the cases, we do better. So this is when using learning from other pairs can help improve prediction on our target pair, that in this experiment was Euro USD. And you can see that, again, in the majority of the cases, we do better, sometimes even significantly 6% better. And in a few cases, we don't do as well. Okay, so this is what's known. What else do we need to do? And one of the things that I really think are important, it's so-called XAI, so explaining the decisions made by these architectures. And let me try to explain why explaining it's needed. So I think the idea is in what is actually deep learning, okay? And I'll give you an example explaining what deep learning really does and why we need explanations and explainability. So let's look at the task of face recognition. So we want to determine whether an image has a human face or not. So one way in which we could attack this problem is divide it into sub-problems. So for example, if you get the input is the pixels of the image, we could use the sub-problem telling us that is there an eye in the top left of the picture? Is there an eye in the top right? Is there a nose in the middle, a mouth at the bottom, hair on top? So if the answer to all these questions, sub-questions, is yes, then we can possibly conclude with some confidence that indeed there is a face in the picture. Now we can decompose further, right? So we can take the first of those sub-problems, is there an eye in the top left? And ask, is there an eyebrow? Are there eyelashes? Is there an iris? And so on and so forth. So deep nets, they do exactly that, okay? So they start with the input and they decompose the problem, the function that you're trying to learn, into simpler and simpler questions. And you have layers, and in each layer, you can study more and more complex questions. So here is an example in the face recognition. So we start from the input, the output is going to be, is the face there or not? And in layer one, so the input corresponds to pixels. In layer one, we are looking at the edges of the face, for example. In layer two, we build on the knowledge we acquired in layer one. So now that we know how to recognize edges, can we recognize object parts? So which means eyes, nose somewhere, yeah, nose here, and so on and so forth. As you move and you build on top of the knowledge you built in lower layer, you can recognize objects eventually. So unfortunately, it's not always as clear, okay? It's not always the case that I can tell you what the DeepNet learns in layer one or what the DeepNet learns in layer two. And especially when you move to more complex architecture, like the long short-term memory units that we used for our cryptocurrency example, or recurrent neural network where the past information or the past decision a network has made is also input to the decision at the current time. And other architecture are also important, like encoder, decoder, the one we've used for live data. Now, when things become complex, we completely lose track of why deep nets make certain decisions. The good thing is that we use it because we have lots of data. As we said, for example, in high frequency trading, this data produced every second or so, or even more often. And we do have hardware and software now that are optimized for deep learning. So that's why 2/3 of the companies in the city probably use machine learning, because they're able to work with lots of data and probably denoise it because these data sets are noisy, and find signals like we've shown for cryptocurrencies and Forex, and hardware and software are available to work with them, okay? GPUs are not that expensive for an incumbent company that wants to innovate in finance, and there is software libraries that allow you to write deep nets pretty easily. But why not deep learning? And that's, I'm quoting a picture from the survey. It's because there's a lack of explainability, okay? Now you can see that these are the responses of people who participated to the survey, and you can see that according to the sector in which the companies work, they care more or less about explainability. But if you look at the ones that they've given the higher weight to the lack of explainability, it's in investment and capital markets. So if I have to make a decision and take positions, for example, buy Bitcoin or sell Bitcoin, in input what the machine learning algorithm told me, this is not a way that investors like, because investors want to know, why are you buying Bitcoin? One answer is because I've studied the situation in international markets and I think that Bitcoin will appreciate. That's one thing that investors like. What investors not like is because a black box told me to do that, okay? So that's part of the problem. And it's a moving target. So I talked to people in the city three years ago, and they said, no, I'm not using machine learning because of lack of explainability, exactly for the reason I just described. I talked to the same guy a few months back, and he said, yeah, I'm starting to use it because I think I can get more out of it. So things are changing, but the lack of explainability, as you can see, it's still important to many people, especially in investment and capital markets. So the idea is to work on explainable AI and get a change in the pipeline to also have an explanation interface, okay? So something that as a user, I can get answers to this question. So I understand why not. I know when you succeed, I know when you fail, which is completely unclear currently. I know when to trust you, I know when you made a mistake, okay? So this is something that XAI is a very hot topic in research in general and independently of finance. But I think because of the reasons I just discussed, it's even more important in finance.
Yeah, so we actually have a question from Paul. So he's asking, can the network be too deep so the gradient at a node becomes weaker with more layers?
Yeah, so it can be too deep, especially because it becomes hard to train. Yeah. So it's always a trade-off between getting more of this intermediate knowledge that you build in the hidden layers and train the network. But we do not have a concrete or a sound understanding on in which cases it works and in which cases it doesn't. You know, what's the best number of hidden layers for your particular setup? It's completely a heuristic kind of question at the moment. And I'll be controversial and say that in this context, designing deep nets, for example, it's an art and not a science, okay? Especially because we don't know all the answers to these questions, okay? So don't go around repeating what I said, because this can be controversial in for some audiences. Okay, so let me move to the second of the topic. So in 30 minutes, okay, so I'll probably, so this is a very recent work that we did with Shen and John about hedging financial derivatives. And the idea here, it's not ours, but it's actually been established by a number of people in the financial maths area. And in particular, Hans Buehler, who works for JPM. JPM are investing a lot, are putting a lot of money into the AI for finance research. And the idea is it's very simple. So we have a nice mathematical model that's used to compute prices of financial derivatives, in particular options. You don't need to know the details. This has been very important and influential. This is called Black-Scholes method. And without that, probably we wouldn't have had all the development in financial markets and derivatives. But one problem of this approach is that, as every kind of mathematics, to work needs some assumptions, and these assumptions are not always true in reality. In particular, for example, if I were to use a hedging of options, which means that I want to reduce as much as possible my exposure against these derivatives. So I want to trade, I'm exposed because I have this derivative, and I want to trade on the back in a way that I'm not going to pay anything, whatever happens to the market. So there is a technique that you can use in Black-Scholes that's called delta hedging, that works when there are no transactions fees, when I do my transactions to protect myself against the option. So the idea of these guys is to do deep hedging. So I'll use a deep network of some sort, of some description, that also accounts for market constraints, for example, trading costs. Now, the hedging strategy that this network gives me is going to be aware, and it's going to work also considering all the frictions that are currently in the market. Okay, example, trading costs. So what with John and Shen say is that, what if we now modify this idea, this pipeline, and only hedge when it's necessary? So we only trade when things require, when the market conditions require it. So what we do, we add an extra input to the pipeline, which tells us what's the price change in the asset that we are on which the option, underlying the option. And we only trade and hedge when the price has moved a lot. Okay, so which means in Buehler's example, you trade every day. So every day you hedge and you try to protect yourself against what's going to happen in the option. Here instead, you only trade and you protect yourself when the change is big enough. So we are not going to trade 30 days, we're trading less. And one more step that we consider is what if we now also add a bit of prediction on what's going to happen tomorrow to the price of the underlying asset. And we only trade when the change is big enough, the change in the past is big enough, and we do not expect that the market moves in the opposite direction, okay? So, because if I expect tomorrow that the market will go similar to where I am today, there's no point in hedging against this maximum. That's the idea. And what we can get, it's something that we call the efficient hedging frontier, which basically means that you can trade off the hedging loss, so how much money you lose with respect to the derivative and you taking these hedging positions, versus the standard deviation of the terminal loss, which means the risk of hedging. And as you change the alpha is this parameter here. As you change the alpha and you trade less and less often, your cost, it's reduced because you pay less trading costs. So your cost is reduced. So these are small cost, large cost. As you move from left to right, your cost decreases because you're not trading, you're not hedging. But your risk is much higher here than here. Okay. Now, this is an efficient frontier because there's no two solutions. The two solutions are incomparable. Each two pair of points for the same percentage of trading costs, it's incomparable. So, for example, this point has a lower risk and a higher cost than this point. Okay. So now, according to the risk appetite of the whoever the hedger, a point on this curve can be chosen by appropriately selecting an alpha. If we also add the prediction and we do not hedge when we have a maximum minimum point, we can move this frontier from here, this is the original one, for 5% trading cost, to up here. So we can get even better solutions. All right. So are we done on deep hedging? No. So for example, I talked to UBS and they say, this is nice, but this is so-called vanilla options. What about these nicer derivatives that we consider like exotic derivatives? I don't know. So what we do only works for vanilla options, the easy ones. And there is also a very nice paper that people have put on arXiv that talk about risking models in model risking in finance. And they have this nice table with all the things we need to think about when we use black box models to reduce risks. So there's a lot to be done. All right, so the last question I wanted to discuss was designing better markets. This is a joint work with Wong and Maria from King's and Leslie and Lingbo from Data Spartan, who's a company in the city. Okay, so what the idea here is that the way you design markets is important for their stability. So the technique and the design that's currently used in the majority of exchanges is something known as continuous double auctions. That means that every time the bid and the ask, so the bid is people wanting to buy the asset and the ask is people wanting to sell. Here we have a price. So you see that the price that sellers want is higher than the price that buyers want. In continuous double auctions, as soon as the two lines touch, you clear. So you make a transaction. So what this effect has on the behavior of traders is that this incentivate people and traders to get to the market as soon as possible. Okay, that's why we have this proliferation of so-called high-frequency traders. And the high-frequency traders have a number of side effects. One being that flash crashes can occur. Okay, so this is something that happened in May 2010. In few seconds or minutes, a lot of money was wiped up out of the market. So high frequency traders, it's not clear whether they're good or not. But what we try to do in this work is to say, probably we shouldn't favor people just because they are faster to get to the market. We should favor them when they take positions that are not simply guided by greediness. And this actually works on a proposal by Butish, Crampton, and Shim in 2015, who proposed something known as call markets, which means we run the auctions, so we clear bids and asks only at certain time intervals. So for example, here, then in all this time, we wait. We only collect orders. And then we clear again. And then we collect orders. So it's, in a sense, you slow down the market a bit, just because you want to avoid giving this incentive to people just to get to the market fast.
Carmen, we've got another question from Paul. Just in case I botch anything, I do recommend you also read the chat. But he states, in convolutional networks, I understand that the dot product is used as a filter to produce intermediate features. Is there a similar dot product in a financial application?
No. And that's stuff, for example, that some PhD students at King's are exploring, the extent to which you can use these pooling operations in finance. So no, there's no, nothing it's known in that respect, as far as I know, of course. Yeah, and to come back to these call markets, so the idea of Butish et al. Was to have this fixed interval in between two different auctions, two different times in which the markets and the buyers and sellers are matched. So what we propose here is, let's use an adaptive clearing interval, so which means we clear when the market requires to be cleared. So if the market is very volatile, we don't want perhaps to clear, we want to wait a bit longer, just to wait for the market to stabilize a bit, or vice versa, we might want to clear more often when the market is volatile and wait when the market is stable, okay? The question is, does this make sense? This makes sense. I mean, having fixed interval, these guys show that makes sense because you are less exposed to all the dangers of high frequency traders. Here, we want to understand, does this make sense? Do we buy anything over this? And the answer is that yes. I mean, there are ways in which we can design these adaptive call markets, and I don't want to spend too much time on these graphs, but we can get better than fixed interval call markets, and much better than continuous double options that are the blue lines here. And you can, one thing I want to say is that you can look at markets from a number of different perspectives. So you can care about efficiency, how well sellers and buyers are matched, spread, so the difference between buying and selling price, volume, how much is transacted, and surplus. So in all these dimensions, we can get a picture that these adaptive call markets are not too bad. Now, what to do is, one thing would be, what is the best adaptive clearing rule? But there are a number of things, and this is why I want to conclude by talking about the Bank of England 2021 research agenda. So these are two quotes. Technological innovation and systemic developments raise novel issues for financial policymakers, and in particular, the topics they would like people to study is what are the implications of machine learning and AI for the system? How can ML and AI be deployed by regulators? What are the implications of cryptocurrencies? And yeah, other stuff. So I mean, the 2021 research agenda is full of these kind of questions that I try to discuss in this presentation. But to really answer these questions that the Bank of England cares about, there's a very big question that's probably not easy to answer, but we should work towards it, is to get a realistic market simulator. The problem with finance is that we do have one historical path of what's happened. But if, for example, I wanted to study the effect of using a new machine learning algorithm into markets, I wouldn't have counterfactuals. I could only see what happened in the past. I cannot predict what's going to happen in the future. So we really need to do experiments with introducing AI players in financial markets. And to do that, there are challenges that need to be overcome. I have here 3 challenges that are extremely hard in their own right, but putting them together, it's even more complex. So one would be, can I generate any synthetic data in financial time series that would be able to, first of all, make sense, so it's realistic, but also account for the fact that now I have a new AI machine that's trading, and I want to understand how the market will change. Of course, these machines are often designed as reinforcement learning agents, and studying this, the way these reinforcement learning agents learn from the market and change their actions, it's important. And finally, as we saw for high frequency traders, the incentives are super important. So the people react to the way you define the markets with following their incentives, so that they're in the game to make money. So if you change the rules of the game and you become adaptive, they will change the way they operate and they behave. Okay, so this is something for the future. And I think, you know, people have been writing market simulators forever. It's often the case that they are able to explain what happens after the event has happened, which is probably not very useful. We'd like to have a prediction power from these simulators. And yeah, so we think that these 3 challenges at least need to be solved and overcome. Okay, yeah, so this is all I wanted to say. I mean, one reason for which I really like, let's say, computational finance or AI in finance is because it's one of these multidisciplinary areas where you need ideas from different perspectives to really get a good solution. So I hope we'll get there. And in this spirit, there's an opportunity to work at King's with a funded PhD in between mathematics and CS. So you saw that, for example, in deep hedging, there was some financial maths, and there is some ML and AI. So we think that working across disciplines will allow us to get more answers. So there's some details here, but if you want to know more, you can get in touch with me. So this concludes what I wanted to talk about today.
Cool. Thank you for that, Carmen. That was really good. I've got a question myself. We still have a minute before we have to jump off.
Yeah.
We've got another talk right after this. But a question from me, rather vague actually. Do you think, I think especially recently, people have been talking more about it, how when it comes to investing, be it in companies or pretty much anything else, the value in what we're investing in no longer strictly, I say strictly because it still obviously influences it, dictates the value of the stock, as it were, or whatever it is that we're investing in. Do you think, and I realize this is a very broad question, that the direction that we're heading with, where we have bots trading with bots, do you not think that could create some sort of a bubble, or that there could be a problem there where, you know, we have machines trading with machines?
That's exactly what the Bank of England cares about in their 2021 research agenda. It needs to be studied, and that's exactly what I was saying. So if we had a market simulator, we can put our bots together and we can see what happens to the market, and I can give you an answer. Otherwise, I can't. The only thing I know is that there's a parallel that in retail markets, if you use these automated pricing agents, for example, what happens is that these agents, so the prices you get on Amazon, they learn, because they are optimized, they learn to be a cartel. Okay, so in that particular case, retail markets, yes, the answer is that actually using AI, it's against us as consumers, just because they're super optimized to follow profit.
Mm-hmm.
Financial markets, it's much more complex than retail markets, and we have no answer, I think.
It's interesting, yeah. It should definitely be studied more.
Yeah, I think it should be, yes.
Right, I believe we do not have any more questions. It was a fantastic talk, so thank you for that. Just for everyone on the call, just so you're aware, we do have another talk coming up in 9 minutes. As we jump off of this, remember to go on your next link. It is different, and that will be Gustavo Pereira from Spotify, who will be talking about understanding audiences for advanced clustering techniques. So another technical session. Should be fun, so more fun over there. But yeah, thank you, Carmen. It was absolutely great.
Thank you for the invitation. Thanks for everyone for attending.
Yeah, thanks a lot.
Bye.